Okay, we all know it's really tough out there at the moment. You know, the economic environment, pressure on costs is really difficult. Insurance is a big overhead for businesses, and companies need to take steps to try and keep those costs under control. So, it's quite reasonable that businesses should look at two things in my view. Firstly, it's quite right they go out to tender. Every 3 to 5 years they should get a second opinion on their insurance programme. Not just focused on price, although always a key element, they should also look at the advice they're receiving, make sure they're reviewing the level of cover and the scope of protection they're buying. Going out to tender every few years will just make sure you're getting good advice and good value for money. The other thing businesses can do is really take responsibility themselves for trying to reduce and manage their own risks. So what are they doing about health and safety to reduce employee accidents in the workplace? When was the last time they reviewed their security systems and their fire safety systems? If you can keep the claims off your record, that will help keep your premiums down. So what's happening in the market at the moment to premiums? The good news for customers, it's very competitive out there. Insurance companies are fighting for business, they're looking to grow market share, and that's translating for a lot of businesses into reductions in premiums. Most businesses should have seen their premium costs fall in real terms over the last 3 to 4 years. And if they haven't, they need to be going out to review. So what does this mean for 2012 and beyond? My prediction is that businesses will start to see premiums rising. I don't think they're going to be too severe, the increases, but they need to take that into account when budgeting and, of course, talk to their broker in good time so that your expectations are met and there's no nasty surprises. One of the areas that businesses often overlook is protection against bad debts. We call that trade credit insurance. You know, at the moment, they're predicting we're about to go into another recession, the double dip, and insolvencies are creeping up again. So this is a big issue for printers. Nobody likes to have bad debts that can wipe out a whole year's profits in one foul swoop. So what can you do about it? You can buy trade credit insurance. Not all businesses do. It's a specialist cover, but what goes with trade credit insurance is an awful lot of risk management support to help give you access to information to manage your credit risks. You know, it still amazes me that a lot of businesses don't check their credit status of potential customers and existing customers on a regular basis. You know, a business can have the best insurance protection in the world, but they still need to think about how prepared are they if disaster strikes. You know, there's a really telling statistic, 80% of businesses that have a major disaster will fail within 5 years. It's because management hasn't taken steps to plan for the unforeseen. The best way to deal with that is for a business to prepare what's called a disaster recovery plan, sometimes called a business continuity plan. It's the same thing. And that's about the management and the key people in that business taking the time out to think about what they would do if different types of disaster struck the business. So what if they couldn't get into the premises for a week? What if there was a fire that totally destroyed the building? What if there was a flood? Could be anything. They need to think about the different scenarios and then think about the steps that they can take to minimise disruption should that occur. So it's about planning contingencies so that you have a fallback plan to take action and make sound decisions at a time of extreme pressure if disaster strikes.